there, good afternoon. You've tuned into Mutual Fund Corner on CNBC TV 18 and I'm Vinnii Motiwala. Last week we did have the AMFI data that came in. Some key points came in from that front. Now, equity inflows in Feb 2025 saw a bit of a fall coming in on the back of the volatile market movements that we've seen. They came in at around 29,241 crores. Sectoral thematic funds that continue to see a bit of a decline, 36% decline. And the mid and small cap funds that also saw a bit of a decline on the monthly basis. Now, there are certain concerns coming in. Is this the trend that will continue? Is it signaling some bit of a fundamental shift in terms of the sentiment of the investors? What should you all be doing while investing? Looking at this AMFI data, today we do have Chirag Mehta, Chief Investment Officer at Quantum AMC, joining in with us to decode the AMFI data, expected trends going forward, and what should you all be doing as investors. Chirag, thank you so much for joining with us on the show. And, at a time when everyone is so worried about the data points, you keep hearing people wanting to know whether to shut SIPs. But equity inflows, for this month, in the month of February, has seen a decline, right? So this is the lowest level that we've seen in terms of for the equity inflows since April 2024. What do you think that has triggered this sharp pullback that we're seeing? And is it maybe just investor fatigue in terms of the market or volatility that's a major concern, or valuations that are shaping up as a concern for investors? Anything that you have read on this front?
So yes, Vinnii, if you look at valuations, they were a concern. We were trading at very high valuations, especially in the mid and small cap. Even large caps were, one standard deviation over and above the long-term averages. So yes, we were trading with high valuation per se. But if you look at the flows data, right, it is, if you decompose that, it is made of net flow is inflows, and what redemptions you have seen, the net becomes net inflows. So from that perspective, in September, October, we were seeing some sort of redemptions hitting mutual funds, and that led to net inflows still staying high, but because inflows were supportive at that time. Now we have seen redemptions start to decline a bit, a tad lower than what we were seeing in September, October, during the peak market levels. And what has happened is inflows have started coming down. So earlier it was more redemption pressure, and now it is more inflows declining per se. And I think this augments in terms of the shift in some sentiment, because, there was a lot of money or liquidity moving in mutual funds. And it was across the board that we were seeing flows come in. And over the last 2 years, it was more driven by thematics, small cap, mid cap, as opposed to, hybrids or large caps taking the place. And from that perspective, given the fall, which was really sharp in the small and mid cap segment, given valuations were even higher there, it led to the outflows. It triggered the outflows in some sense.
Absolutely. So because of this valuation, so now coming to the point of specifically mid and small cap, then given that if valuations were high, and we have spoken, everyone knows about valuations being high in mid and small cap, then do you think this is going to be something more permanent for the mid and small cap side, at least in the near term or the next 1 year? Flows for the mid and small cap funds could be a bit lower.
I think, everyone needs asset allocation, right? And also within the asset allocation buckets, like equities, there is a place for large caps, which becomes the liquid foundation aspect of the equity bucket. And then you add on mid and small cap to increase your returns, while you also are aware that you are taking risk in that segment. So small cap, mid cap valuations are still high. But I think there could be some rotation and some rejig and proper way of building the equity portfolio, of moving money out of small cap, mid caps to some extent, and moving to large caps or hybrids to some extent that we may see over the next 6 to 12 months. So yes, valuations have come off and are looking reasonable in certain pockets. But on an aggregate basis, they're still high, and probably, may lead to investors moving from this high valued zone towards large caps, which are more reasonable, closer to the long-term averages. And therefore, that could trigger some shift from the small mid-cap thematics to large cap kind of allocations.
Okay, yeah. So that could be. So thematic funds also maybe could continue to see this decline, right? What we've seen right now, this 36% decline on a month-on-month basis is what I'm talking about. Then that is something that will continue in this front as well. And maybe hybrids could start seeing an increase is what you're highlighting.
Yeah, absolutely. I think we may see that shift towards a proper asset allocation per se, and moving from expensive pockets to pockets which are showcasing some reasonable valuation levels, and therefore investors should be looking at very closely now.
Okay, just to follow up on that front, for sector thematic funds, do you think there are any opportunities that could come in going forward as well, or looking at the market trends where we could see that increase? And where do you think increase in terms of NFOs would come in for? Is that new fund offerings? Could we see an increase on that front, or that will also maybe take a bit of a backseat?
So we have been seeing a lot of thematic fund launch over last 1.5 years, right? And a lot of inflows have moved into those pockets. Themes are generally launched when, you can showcase a better performance of those themes. And therefore, it becomes easier for you to take that product to the market. But having said that, that typically are not great times to invest into per se. I mean, from an investor perspective, they are better off in an active, diversified equity fund as opposed to a thematic or sectoral fund. So I, as an active fund manager, if I like a theme or if I like to, like a certain sector of the market, then I will have that allocation even in my active equity schemes. Why do you need a thematic or sectoral fund per se? Is what defies to some extent. Some investors who are learned, who are very savvy investors, may want to have a higher allocation to certain pockets which they understand will do well over next 2, 5, 10 years, and therefore have some portion more allocated to those segments. For them, thematic is fine. But on an aggregate basis, on a generalized, for an average investor, I think they are the active equity diversified funds would be a better place for them to allocate as opposed to the sectoral thematic funds.
Okay. Surely that's interesting to be better diversified than just going in for a sector thematic fund. And especially if you don't have in-depth knowledge, I think it's safer to go in for those diversified funds than opting for any options there. Chirag, there are several market voices, top market voices, who have been, raising concerns about those excessive valuations like you were talking about right now as well in those small cap funds. Do you think the SEBI's increased vigilance that has come in for this small cap froth, and reducing that froth in the market, that is also something that is playing a role in terms of the outflows, and people are becoming more cautious than they should have been?
I think the SEBI's vigilance or regulations that they brought about on disclosures of small cap funds was the thing in the right direction. Given that liquidity is a challenge in that space, and given the significant increase in flows that we had seen to that segment, it warranted a disclosure, at least from an investor perspective, to take an increase aware call per se. So if you look at liquidity of many funds out there, with the small decline in markets, we had seen an increase in number of days that took to liquidate as compared to what it was earlier when the regulations was introduced. So it did tell you that liquidity in this segment is dear, and it can dry up significantly as there is differences in market movements. So from that perspective, I think it was warranted in terms of disclosures. Also, you had to remove the 20% of illiquid stocks in one fund and then disclose the liquidity. So to that extent, it was a bit relaxed as well. But disclosures were warranted. So I think it was in the right direction. It didn't do much in terms of triggering this pullback that we've seen in small caps. It was trading at a higher valuation, and it warranted a fall or a decline or a correction, per se, if I may put it that way, given the valuations that we were trading at. So we were trading at significantly much higher valuations. And if you look at our small cap fund, we were holding on to higher cash, which is not a call that we take, but it's a residual of our process. And we were sitting on about 17-18% cash in our fund because of the lack of opportunities at the valuations that we would love to buy. So from that perspective, it kind of validates that it was trading expensive at that juncture.
Absolutely, Chirag. And a lot of other how fund houses also are holding a lot of cash, because I think that's a data point that has come out as well, because everyone is holding on to those cash reserves and finding the right opportunity to invest in. But one thing that really caught my eye, Chirag, was the SIP stoppage ratio. I mean, it's not a very good pretty sign that comes in when you at least look at the number, right? It was around somewhere 60% stoppage ratio in October 2024. Today, when you look at it, Feb 2025, it is 122.8%. That is the stoppage ratio that's come in. This is a bit of a worrying, right? Because if they're discontinuing their SIPs, and they're not starting new ones, one, what would you say, and is to an investor in terms of an advice, as well as in terms of, is this a warning sign, or maybe retail investors are starting to panic and stress a bit more?
Vinnii, we are in uncharted territory per se, because there are a lot of new investors, at least 2 to 3 crore investors who have come into the mutual fund fold post-COVID. And if you look at markets post-COVID, haven't really seen the kind of decline that we are seeing currently. So I think it's about the behavioral aspects of these new investors, which will get tested. We don't have a textbook version of how this will pan out. But overall, I think it should lead to some rejig in terms of allocation if one were over-allocated to, say, certain segments of the market and didn't have a right allocation in place. I think this is a time that that rethink will come. And from a suggestion perspective, I think investors need to embrace equity investment. There is no two ways about it. If you have taken a call to do it in form of SIP, systematic investment plans, I think one needs to continue with that, because given the decision that you had taken at the start of your investment journey, that needs to continue over a period of time to reap the benefits that SIP brings to the table. So far, investors are investing in a rising market. This is a time that they will average out their cost when markets decline and correct. And hence, over a cycle, they would be much better off with continuing their SIPs as compared to stopping it now. Of course, one needs to, again, reevaluate their portfolios, which segment of the market they were exposed to, what risk it could bring, and hence invest in the right way going forward. That rejig is necessary, but I think SIP investments or continuing the investment should continue going forward as well.
Okay, Chirag, one point what I'm not understanding in this, while stoppage ratio has surely increased, SIP inflows, they have not seen that much of a fall. 25,999 around the 26,000 crore mark, right? So what is this indicating? While flows are SIP inflows in terms of rupee amount is there, but the stoppage ratio is also increasing. So what is this trend then?
So there could be new investors that are joining in and signing up for SIP. Some may earlier have said that, valuation expensive, let me be away from the market. With the current decline that we have seen in small caps about 24-25%, and in large cap about 14-15%, would say that now it makes sense to go into the market. I don't know where the markets will bottom out, but let me at least start my investing through SIPs, and therefore a new breed of investors who are away from the market may be joining, and all those who were investing earlier and now seeing declines in their monthly statements in terms of returns that they are fetching may be stopping. So it's two different kind of investors reacting at the same time that is causing this dichotomy that we are seeing in SIPs overall. That stoppage is ratio increasing, but still flows being maintained overall.
Okay, and if there's a new investor who's starting SIP right now, right? It looks attractive to start right now. Markets are falling. When you see that fall coming in, you find it attractive. Where should they start their SIP with? What sort? There are so many options out there. So which is the best option in the current scenario? Like whether you go hybrid or just mid cap, large cap, small cap, what is it that you would say?
So if one is new to investing, I think they should start with something that's very, very liquid in the equity space and very large cap oriented. So they should set that as the foundation. Hybrid, I don't think that you need SIPs. You can do SIPs, but you are asset allocated if you're allocated to a good hybrid fund, then you are already asset allocated. Then therefore you can also do lump sum there. But if you want to do SIPs, probably large cap liquid allocation that makes the foundation of your equity assets, I think that should be your starting point. And as you become more mature and as valuations correct in the mid and small cap, you can augment your allocation over a period of time towards that segment as well. So I think that is how one should look at. One should look at the allocation, asset allocation, and allocation within each asset class as a triangle. And the bottom of the triangle has to be that liquid, less risky segment of the market. And as you go up the curve, you take more risk, and therefore you get more returns in that space.
Okay. On that note, we're going to slip into a very short break. Don't go anywhere. We're going to be continuing this discussion with Chirag. So stay tuned in for that. Welcome back. You're watching Mutual Fund Corner on CNBC TV 18. We are talking about the AMFI data that came in for 2025. We're continuing the discussion with Chirag Mehta. Chirag, what is interesting also that, and what has piqued interest of investors across the globe is gold. And gold ETF schemes also, they continue to see a bit of a trend. This geopolitical tension, gold is surely shining bright. There's no stopping that one. Do you think this gold ETF trend maybe could further see an increase in the next couple of years? And is that an interesting bet that an investor could look at right now?
Yes, I think we have seen continuing flows in gold over the last 7-8 months. We have seen positive flows coming in gold ETFs. If you look at investors from an asset allocation perspective, I think are under-allocated. Though we may have a lot of gold in the family, but from a portfolio allocation perspective, I think investors are under-allocated to gold. These times where we're seeing stress, uncertainty increase, we are seeing that investors are moving into gold and gradually allocate a portion of their portfolio towards gold-like assets. So I think this trend is here to stay, given that it's nowhere close to the allocations that one should have of their portfolio. And each time we have seen stress in equity markets, gold has done well. So I think it's kind of self-reiterating its importance in one's portfolio. And I think investors will continue to allocate. And today, gold ETFs emerge as one of the best forms of allocating to gold and having it from a portfolio context. So I think gold ETFs will continue to see inflows. Awareness for gold ETFs is increasing significantly. Investors are adopting that in a bigger manner. And gold, given that we have seen good returns, back it up in times of uncertainty, it will lead to more flows coming to gold ETFs overall.
Okay, and with gold, do you think even silver is something that could start seeing an increased interest now?
See, we have a view in terms of how one should look at silver, right? Silver as a commodity, 65% of the usage of silver comes from industrial uses. People put it as poor cousin of gold. But overall, if you see, whenever there is uncertainty or a decline in equity markets, given its association to growth, silver also falls along with what we see fall in equity markets. So it gives you a similar exposure to what growth assets like equities will give you. And hence, from a portfolio context perspective, you need to have gold in your portfolio as opposed to silver. We have seen 3 bull markets in silver, and all 3 of them were speculative in nature as opposed to anything fundamentally led. So if you understand silver supply demand balance, and if you want to look at it from a trading perspective, it's fine. Right. But from an allocation perspective, gold suits the best. Gold
suits the best, but gold, debt, and equity funds, if you have to pick in the next 12 months, what would you be looking at the most, and what interests you the most?
So I think asset allocation is what one should look at. But if you put a gun on my head and ask me to pick one of them over the next 12 months, then I think it's going to be equities. I think equities will give you a good opportunity to build an allocation over the next 12 months. Sure. And I think in a market like India, where you see high rates of inflation, currency devaluations, etc., I think equities will help you protect or earn better returns than the inflationary trends that you will see over a period of time, and help you wealth create in a true sense. So I think equity is what one needs to embrace and build an allocation over the next 12 months.
Sure. And just one last word, March 25. How are we expecting these numbers? What has shaped up so far? If you could just give us quick details on that front for the mutual fund industry.
Sure, absolutely. So I think what we saw in Feb is going to be very similar in March. markets have corrected a bit further and stabilizing at current levels. But I think from an investor behavior perspective, we will see very similar trends to what we saw in February. So I think people will continue to allocate, and you will see interest increase as valuations become more sanguine and give you an opportunity to buy. So we will see similar trends in March. But hopefully over a period of time, as we see more buying opportunities, I think the flows should start reversing and coming more positive. Until then, I think we will see the same trends that we are seeing now.
Okay, so this trend that we're seeing in Feb 2025, that will continue in March 2025 as well. And maybe in the near term also, next few months is something that would be similar, right? Or there could be a different story in the new financial year is what you're watching out for, or this similar trend?
Should be similar, but we don't know the behavior of many of these new investors. That will be tested, and we will come to know in terms of how they behave, if they continue with the resolve to invest or they panic.
Okay, absolutely. This is a time that, I think the market is testing the new investors. So it's time to, just pass this test, get through this, continue with your SIPs, I think. Do not just panic and stop, I think, is the word coming in from everyone. But Chirag, thank you so much for joining in with us, explaining us, the details about how the AMFI data showed up in 2025, as well as what it could look like in March going forward as well. So yes, that's about the AMFI data, where we did see some bit of a decline in terms of equities flows in Feb. But overall, maybe this is a trend that could continue in this next couple of months. That is what we're keeping an eye out on. Stoppage ratios increase, but inflows have been maintained because there are new investors maybe who are starting to see some bit of a bet coming in as a better opportunity. And that is what the understanding we've gotten right now from Chirag Mehta as well. So with that, viewers, we are absolutely out of time in this edition of Mutual Fund Corner on CNBC TV 18. Thank you so much for tuning in. As always, up next, you have Closing Bell.